We just received last night the 155-page discussion draft for the bipartisan market structure of digital assets in the United States. This single-handedly is going to define how digital assets like Bitcoin, Ethereum, XRP, HBAR, XTC, pick an asset, are defined under United States law. This is going to separate winners and losers. This is the most important piece of crypto legislation that has so far ever been written in the United States of America. Not only does this decide who is regulating crypto, but this decides who can custody crypto, who can build with crypto, and who gets pushed out of the system entirely. I'm going to load my screen up here because we have a lot to get into today, and this is going to be the focus of the entire video, is a deep dive on this draft here. So, if you don't understand what's in this 155 pages, you are not going to understand where the entire crypto industry is headed next. And this isn't about the end of crypto. This is about cryptocurrency becoming infrastructure. For more than a decade, I guess, for some background and context here, crypto has lived in regulatory chaos in the US. The SEC called almost everything across the digital landscape a security. The CFTC claimed they were commodities. The result was confusion, lawsuits, and innovation going overseas to places like Hong Kong and Singapore and Dubai and Bahrain and all of these nations that have provided, at least at the minimum level, a sandbox environment for innovators to innovate. This 155-page draft that we just received is Congress's beginning to an answer for a framework that may end the confusion once and for all. This draws the map on who regulates what, how exchanges must operate, and how investors, developers, and institutions can finally participate legally. Translation, the U.S. isn't trying to ban crypto anymore. It's trying to wire it into the financial system itself. Under Section 101 within this 155-page document, a digital commodity is defined as a fungible digital asset that can be exclusively possessed and transferred peer-to-peer on a public blockchain. Not a security, not a deposit, not a stablecoin. That definition opens the door for the CFTC to oversee these markets directly. Exchanges, brokers, and custodians dealing in digital commodities will have to register separate customer assets and report trades, exactly like commodity futures markets. This is the adult version of crypto trading. No commingling of funds, no unregulated self-dealing, real oversight, and real audits. For context here, anybody that's ever tried to, and I recommend that you all do it, file your taxes if you deal in digital assets. It is a nightmare. I would assume that this all kind of changes as well. Anything that represents profit share, equity, or enterprise ownership under this draft bill will stay under SEC jurisdiction as a digital security. But here's what's new. The bill creates a digital asset certification process. Imagine that. A project can actually apply to the SEC to prove it's sufficiently decentralized without, hopefully, receiving a Wells notice if trying to kind of do things the right way. Now, if approved under this digital asset certification, regulation will flip from the SEC to the CFTC. For the first time ever, decentralization becomes a legal status that you can earn. This means that, yes, for cryptocurrencies that launch initially as securities, there is a path out of the security bucket that will finally exist. Lane number 3 within this document. So we talked about commodities. We talked briefly about securities. Commodities under CFTC, securities under SEC with some clear guidance there. Lane number 3 is stablecoins and tokenized cash and or banking oversight. Section 809 through 817 within this document carve an area for stablecoins out of the commodity definition and put them under banking and payment law. So in practice, this means that only fully reserved or potentially even over-collateralized transparent stablecoins will survive. Algorithmic models and shadow banking structures look like they may be done. We saw, obviously, the major crash of UST in the last cycle, which I believe was an algorithmic Maybe it was a hybrid model, but still. This aligns stablecoins with the same rails that exist within the United States banking system, a future where your on-chain dollars are supervised just like deposits in the banking system. And lane number 4 within this document is everything else. NFTs, loyalty points, in-game items, the things that are going to be innovated that can't be defined yet, which certainly happens with any new nascent technology, is that that's the thing with tech, is it keeps getting techier and more innovation occurs. Section 988 through 997 within this bill draft make it clear that artistic, collectible, or in-game digital items will not be regulated as commodities, ensuring that innovation in gaming, art, and loyalty systems continue without CFTC registration. Not everything on a blockchain, bottom line here, is going to become a security or a commodity. Now, Section 3 of this little spiel that we're doing here is building out the infrastructure, digital commodity exchanges. Crypto exchanges must register with the CFTC. They must segregate assets and use qualified custodians. Interesting that they mention segregate assets here. Now, one of the things notable that we saw happen with an exchange like FTX is, they were leveraging consumer or customer funds and essentially trading with customer funds, which, you can see why some of these exchanges have defaulted and things like that in the past here. That is going to be a big no-no. Exchanges are also banned from trading against customers. They must publish real-time market data and stop wash trading and manipulation. In short, no more FTX, like I just said. Qualified custodians, section 1540 to 1547 within this document, if you're interested. Custodians can be banks, trust companies, or new CFTC supervised entities. They must maintain one-to-one reserves. They must submit to independent audits and disclose sub-custody arrangements. This is how BNY Mellon, State Street, and other institutions legally enter into crypto custody. Self-custody protection, section 2237 within this bill. One line in this bill changes everything. Quote, nothing in this act shall be construed to restrict the ability of any person to self-custody digital assets or to conduct lawful peer-to-peer transactions. For the first time, United States law would explicitly recognize the right to hold your own keys and the right to transact with others at the peer-to-peer level. Washington just admitted what this space has argued for over a decade, that self-custody is a right. It is not a loophole. Now, transition and implementation into this new system. This is Title 4 and 5 of this document. The bill gives regulators up to 270 days to write detailed rules. In the industry, up to 2 years to comply, assuming this bill gets through. A digital asset advisory committee will guide Congress during rollout, meaning that crypto will literally have a seat inside of Washington. And at the global context level, this draft doesn't appear in a vacuum because we know other jurisdictions in the world are already further ahead. This mirrors things like the European Union's MiCA framework, or MiCA, however you pronounce it, which is markets and crypto assets, the United Kingdom's digital securities sandbox, the Bank for International Settlements project Agora on tokenized deposits, and probably countless more examples that we're not going to be getting into here. But the message is clear. The United States wants to align with global standards so it doesn't fall behind in the tokenization race. And as we've talked about many times on this channel, some of the biggest institutions and entities in the entire world are saying that the entire planet's going to be tokenized. You have DTCC saying 100 trillion, et cetera, et cetera. This bill, 155 pages of definitions, disclosures, and oversight, is how America finally joins that race. So what does all of this mean for you and I? The Wild West phase of crypto is at least in part coming to an end. Exchanges will begin to look like institutions. Custodians will look like banks. Stablecoins will look like payment infrastructure. And for developers and investors, clarity will finally, hopefully, replace confusion. We talk about a level playing field. Imagine actually a world in which we can participate in some of the innovation going on without being traded against by the black box that is a lot of the crypto industry still. There is a lot of manipulation still occurring. The networks that can operate under this structure that can survive adult supervision will form the foundation, as we mentioned many times, of a new financial internet. The ones that cannot abide by what is happening here will end up fading out. It's not death, it's evolution, and it's crypto coming out of its adolescent phase into adulthood. As we close out here, this 155-page draft tells us a bit about everything we're going to witness here with the next phase of crypto. The speculation era may not be ending. That's going to, obviously all can always continue. Speculation occurs across all markets and all industries, but the infrastructure era is just beginning. Regulation isn't the enemy here, it's the bridge. And the ones who see that will be the ones building the future. So we can read between the lines. We can follow some of the entities that we know have been, sticking, essentially digging up the dirt here and trying to make sure that this industry is regulated appropriately. Watch the infrastructure form. Think about Ripple putting in an application to become a bank, and they're not the only ones here. You can think about, even in look at Constellation, been building and with the U.S. government for years. Digital Chamber of Commerce, who a lot of these members, I know XTC, Constellation. I don't know if Ripple's a member of Digital Chamber of Commerce or not. But all of these entities essentially kind of trying to pave a path forward for the United States before it was cool to do so. Think about even Hedera, educating some of these institutions throughout the world. But watch the infrastructure form. Obviously, this isn't the end of crypto. It's the beginning of a system that finally connects it to the world. Hope you guys enjoyed this video, and I hope this was a decent enough, short deep dive into what this draft bipartisan crypto market infrastructure bill represented. I will talk to you guys when I talk to you. Thank you. Bye.